Here's what nobody tells you about index fund investing. Back in 2008, a guy I knew through my accountant put his entire retirement into VOO when it launched. Smart move, right? Track the S&P 500, set it and forget it. 10 years later, he's at a country club telling me how he doubled his money. Feels pretty good about himself. Meanwhile, his neighbor who nobody thought was particularly bright put the same amount into a Fidelity ETFs ETF nobody talks about. His money grew 7 times over, not double, 7 times. Same decade, same market, completely different outcome. And here's the part that'll make you uncomfortable. The smart guy's still bragging about his S&P returns while paying Vanguard fees. The neighbor retired 4 years early. So the question isn't whether VOO is good. The question is whether being good is good enough when better options cost the same and nobody's telling you they exist. I'm going to walk you through 3 Fidelity ETFs that have systematically crushed VOO's performance. And more importantly, I'm going to explain the incentive structure that keeps financial advisors from mentioning them. Because once you understand why certain products get recommended and others don't, you'll never look at investment advice the same way. By the way, I built a free early retirement calculator because most online ones use garbage math. It applies actual BlackRock and Vanguard withdrawal logic to show you where your plan breaks, and I only need your email to send the report since I don't store your data. Links in the description. Think of your portfolio like a 3-legged stool. Most people are sitting on a 1-legged stool called the S&P 500 and wondering why they feel unstable. One leg is growth, the thing that makes you wealthy. Second leg is income, the thing that pays you while you're getting wealthy. Third leg is defense, the thing that keeps you wealthy when everything's on fire. VOO gives you a mediocre version of all 3. These 3 Fidelity ETFs each master one leg. And when you understand how they work together, you realize the entire financial advisory industry has been selling you an inferior product because it's easier to explain. Let me tell you about a poker game I sat in on back in 2019. This lawyer at the table kept going all in on mediocre hands. Not terrible hands, just consistently average. He'd win small, lose small, end the night basically even. Classic S&P 500 mindset. Then there's this quiet guy in the corner who barely played, but when he did, he bet big on genuinely strong hands. By midnight, quiet guy had tripled his buy-in. The lawyer was still grinding. Here's what the lawyer never figured out. In poker and investing, being selective beats being consistent. VOO is the mediocre hand you play every round. FTEK is the monster hand you wait for. FTEK is the Fidelity MSCI Information Technology Index ETF. Over the last 10 years, it returned 751%. Let me translate that into money you can spend. $10,000 in 2016 became $85,000 by 2026. Your money multiplied by 8.5 while you slept. VOO during the same period? About 250%. Good, sure, but we're talking about the difference between turning 10,000 into 25,000 versus 85,000. That's $60,000 you left on the table by being safe. The expense ratio is 0.08%. That's $8 per year on every 10,000 you invest. Same price as VOO, 8 times the performance. You're getting Apple, Microsoft, Nvidia, and 300 other companies building the actual economy instead of just riding it. Now you're thinking, but Bobby, tech crashes harder. Yeah, it does. 2022 was brutal for tech. But here's what your financial advisor won't explain because it complicates the sales pitch. If you're 42 years old, you've got 23 years until traditional retirement. A 20% crash that recovers in 2 years is noise. What matters is the long-term growth rate. And tech's long-term growth rate is roughly double the S&P 500. This is where it gets interesting. The reason nobody recommends FTEK isn't because it's risky. It's because explaining sector concentration takes more than 5 minutes, and most advisors are managing 200 client relationships. VOO is the McDonald's of investing, not because it's good, because it's easy to order. Every advisor can point at a chart that goes up and to the right and say, diversification, low fees, trust the process. That 3-minute conversation keeps their book of business moving. But you're not their book of business. You're reading this because you want to know how money actually works. So FTEK handles the growth leg of your stool. Now let's talk about the leg nobody builds correctly, income. Most people think dividend investing means buying boring utility stocks that grow 3% per year while paying you 4%. That's not income investing, that's wealth erosion with a mailbox check. FDV is the Fidelity High Dividend ETF, and it does something most growth investors never experience. It pays you 3.02% annually in quarterly dividends while the underlying asset appreciates at 15.8% per year. Stop and think about that structure. You invest $10,000. Every 90 days, you get about $75 deposited into your account. Just shows up. You didn't sell anything. You didn't harvest gains. You didn't trigger a taxable event beyond the dividend itself. It's just cash flow. Meanwhile, that $10,000 grows to $20,480 over 5 years. You doubled your money and collected $1,500 in dividends along the way. The expense ratio is 0.15%, $15 per year per $10,000 invested. That's a rounding error compared to what actively managed dividend funds charge. And those funds typically underperform because they're picking stocks to justify their fees, not to maximize your returns. Here's the part that messes with people's heads. FDV isn't buying dying companies with high yields. It's buying large and mid-cap companies with a history of growing their dividends. These are profitable businesses sharing earnings with shareholders while still expanding. You're not choosing between growth and income. You're getting both. And the quarterly deposits create a psychological buffer that keeps you invested during downturns because you're still getting paid. I learned this from watching my fiscal lawyer manage his own money. He had this rule. Every investment needs to do 2 jobs. If it's only doing one job, it's taking up space that a better investment could occupy. VOO does one job, it tracks an index. FDV does 2 jobs, it generates income and appreciates. Guess which one he owns? Let me give you a real scenario with actual numbers so this feels concrete instead of theoretical. Say you're 45 years old with $200,000 in your 401k. You're 15 years from 60, 20 years from full retirement. You split that money into 3 positions. $70,000 in FTEK, $80,000 in FDV, $50,000 in FHLC. We'll get to FHLC in a second. Over the next 15 years, assuming FTEK continues its 22% annualized return, which is aggressive but historically accurate, that $70,000 becomes $1.4 million. Your FDV position at 15.8% annualized becomes $620,000, and you collected about $90,000 in dividends along the way that you reinvested. FHLC at 10.94% becomes $270,000. Your total portfolio is now $2.3 million. You're 60 years old. You've got real money, and you've got income flowing from FDV that you can now choose to spend instead of reinvest. The same $200,000 in straight VOO at 14% annualized, $1.3 million. You're $1 million poorer because your advisor told you sector concentration was risky and you believed him. And before you start thinking I'm cherry picking time periods, let's talk about what happens when everything goes wrong. 2022 was the worst year for stocks since 2008. The S&P 500 dropped 18%. Tech got murdered. Crypto imploded. Everyone with a podcast was telling you to buy gold and canned goods. FHLC, the Fidelity MSCI Healthcare Index ETF, dropped 5.88%. While the market lost nearly a fifth of its value, healthcare barely flinched. You know why? Because people still need insulin when the economy crashes. Hospitals don't close during recessions. Drug companies keep printing money while everyone else is laying off staff. FHLC has delivered 10.94% annualized returns since 2013. That's not explosive. It's not going to make you rich by Thursday, but it's steady, reliable growth that doesn't disappear when CNBC starts using words like contagion and systemic risk. $10,000 invested in 2013 is worth $38,100. 20 today. And during every market crash in that period, it protected you. The expense ratio is 0.08%, $8 a year per 10,000, same as FTEK. This is the defensive leg of your stool, the part that keeps you from panic selling when your neighbor's telling you to move everything to cash. Because when FTEK is down 30% and you're sweating, FHLC is down 6%, and you remember that your entire portfolio isn't correlated to the same risk factors, you stay invested. And staying invested is how you actually get wealthy. Here's the thing about risk that nobody explains correctly. Risk isn't volatility. Risk is permanent loss of capital. If FTEK drops 25% in a correction but recovers in 18 months, that's not risk. That's price movement. If you panic sell at the bottom because you couldn't stomach watching your account balance drop, that's risk. You just made the temporary permanent. The 3 ETF structure solves this. When tech crashes, healthcare holds. When healthcare stagnates, tech runs. When both are doing well, FDV is paying you quarterly regardless. You've built a system that works in multiple market conditions instead of betting everything on one outcome. This is basic systems thinking that most investors never learn because they're too busy reading articles about the top 10 stocks to buy now written by 25-year-olds who've never lived through a real bear market. Let me hit you with the uncomfortable truth about financial advice. Most advisors aren't recommending these ETFs because most advisors don't get paid to recommend them. Fidelity doesn't have a sales force calling wealth management firms offering kickbacks for putting clients into FTEK. Vanguard has a 40-year head start on brand recognition. When you walk into an advisor's office and say index fund, they hear VOO because that's what everyone else asks for, and they're not getting paid enough to educate you on better options. This isn't conspiracy, it's incentives. Your advisor has 600 clients and makes 80 basis points on assets under management. Their job is to prevent you from doing something stupid, not to optimize every position. They put you in VOO, you stay invested, they keep collecting fees, everyone's fine. The fact that you could have made 3 times more with the same risk-adjusted returns over 20 years doesn't affect their compensation structure. I spent 23 years running a business surrounded by accountants and lawyers who explained exactly how money moves and why certain products get recommended while better ones sit in obscurity. It's not complicated. Follow the incentives. Vanguard has a $1 trillion marketing machine. Fidelity makes better products and charges the same fees, but they're not paying advisors to push them. So you get VOO and you think you're diversified. Now, look, I'm not saying VOO is bad. I'm saying it's incomplete. If your entire strategy is buy the S&P 500 and wait 40 years, you'll probably be fine. You'll retire at 65 with enough money to not eat cat food. Congratulations. But if you're 42 and you want to retire at 58, or you're 35 and you want your kids' college paid for without loans, or you're 50 and you want to actually travel instead of just talking about it, you need better tools. FTEK gives you the growth rate to compress your timeline. FDV gives you the income to smooth out the ride and the psychology to stay invested. FHLC gives you the defense to survive the inevitable crashes without panic selling. Together, they're a complete system that adapts to what the market's doing instead of just passively absorbing whatever happens. And here's the ratio that actually makes sense. If you're under 40, go 70% FTEK, 20% FDV, 10% FHLC. You're maximizing growth while you've got time to recover from volatility. Between 40 and 55, shift to 50% FTEK, 30% FDV, 20% FHLC. You're balancing growth with income and adding more defense as you get closer to needing the money. After 55, go 30% FTEK, 40% FDV, 30% FHLC. You're prioritizing income and defense while keeping enough growth exposure to beat inflation. These aren't rigid rules. Adjust based on your actual risk tolerance and timeline. But this framework gives you a structure that evolves as your needs change, instead of just sitting in the same allocation for 30 years because that's what the advisor set up in 2012. 3 takeaways. First, expense ratios don't matter if you're leaving 70% of potential returns on the table. VOO costs 0.03% and FTEK costs 0.08%. You're paying $5 more per $10,000 to make $60,000 more over 10 years. That's not a trade-off. That's basic math. Second, diversification doesn't mean owning 500 mediocre companies. It means owning positions that respond differently to the same market conditions. FTEK, FDV, and FHLC are diversification. VOO is just exposure. Third, the reason nobody's telling you this is because there's no money in telling you this. Financial advice is a business, and businesses optimize for profit, not client outcomes. Once you understand that, you stop waiting for permission and you start building the portfolio that actually matches your goals. Stop settling for average returns because average advice is easy to sell. The math is public, the expense ratios are identical, and the performance data goes back over a decade. You don't need a license to read a fact sheet. You need to decide whether you're investing to feel safe or to actually get wealthy, because those are different games with different rules. Don't work for money, own the companies that do.